If this money went to zero tomorrow, will my life change in a serious way? In the last week, Bitcoin fell from a high of $84,000 to an intraday low near to $60,000, which is roughly a 22% drop in just 7 days. It is now down almost 35% from its all-time high around $126,000 set in October of last year. As I'm recording this, Bitcoin was trading around $62,000 to $64,000. But this morning, Reuters reported that Bitcoin is back at $70,000. So let's see what just happened in numbers. Let's start with the scoreboard. According to YCharts, which uses data from major crypto price providers, Bitcoin was about $93,000 last month, January 2026. By February this month, it had slipped about $73,000, and by February the 6th, the latest daily reading is roughly around $62,000 to $63,000, which is a one-day drop of about 14% from the previous day and about a 33% drop from early January. At the same time, the total crypto market value fell to about $2.3 trillion, and about 90 of the top 100 coins were in the red. Trading volume surged to roughly $356 billion, which tells you a lot of people were either panic selling or forced to sell. A derivatives report noted that back in February, crypto markets saw about $2.56 billion in liquidations in a single day, the highest since the big crash in October 2025. More than 430,000 traders were liquidated in 24 hours, most of them on the long side, which means they were using leverage and got wiped out when prices moved against them. But this is important. Let's talk about the three forces behind the crash. First, macro, the big economy background. Stocks have been under pressure. Early this February, major US indexes sold off for a third straight day, with the Dow dropping about 600 points as investors moved into the risk-off mode. That phrase just means people are less willing to hold risky assets like high-growth tech stocks and crypto when they are worried about interest rates, earnings, or the economy. Second, we have crypto-specific issues. When prices drop quickly, people who borrow money or use leverage to buy Bitcoin get margin called and forced to sell. That forced selling pushes the price down further, triggering more liquidations. On February 1st, about $2.56 billion of crypto positions were liquidated, mostly long positions, with other 430,000 traders wiped out in a single day. One exchange alone saw around $1.1 billion in liquidations. ETFs also matter now. Spot Bitcoin ETFs pull in and push out large amounts of Bitcoin depending on investors' flow. When money flows into ETFs, it supports the price. When money leaves, ETFs become another selling channel, amplifying the moves. Major business outlets have been emphasizing how these ETF flows can act like a turbocharger on both rallies and crashes. Third, and maybe the most important, is psychology. For months, the story was simple. Bitcoin ETFs are here. Institutions are coming. This is digital gold. Central banks keep printing. Price can only go up. Media coverage highlighted new heights and huge inflows, reinforcing that narrative. But once Bitcoin started rolling over and breaking big round numbers like 80,000 and 70,000, coverage flipped. Suddenly, headlines talk about crash, panic, and what's wrong with Bitcoin. Social media sentiment turned from I'll buy every dip to I'm done with this. This flip from FOMO, fear of missing out, to fear of losing everything is exactly what turns a normal correction into a full-on cascade. Think of it like a school hallway. When everyone thinks the door to the cafeteria is opening, they all rush in the same direction. When someone screams, fire, they all run the other way. The hallway didn't change, the people did. During this same period, if you notice, gold and silver were also under some pressure, but they did not move as violently as Bitcoin. Financial news reported that the gold and silver prices extended declines as the US dollar strengthened and risk appetite changed. But the moves were far milder than crypto's 20+% drop. Meanwhile, stock indexes fell and Bitcoin plunged right alongside them. So here's the point: Bitcoin can be part of a portfolio, but it is not behaving like a calm store of value. It's more like a very sensitive meter for global liquidity and risk appetite. When money is easy and people are excited, it overshoots up. When money tightens and people get scared, it overshoots down. So here's my last suggestion. Before anyone buys another tiny fraction of Bitcoin, another SAT or Satoshi, I will run through a simple checklist. If this money went to zero tomorrow, will my life change in a serious way? Do I actually understand what Bitcoin is and how it works at a basic level? Or I'm just copying someone online? Do I have interest debt I should pay first, like credit cards? Do I have an emergency fund for at least a few months of expenses? If the price drop 50% after I buy, will I panic and sell? If the honest answers to those questions are scary, it might not be the right time to buy more. The goal is not to be early. The goal is to still be standing. Bitcoin is not dead, but it is also not your emergency fund or retirement plan in one coin. It is a high risk, high volatility asset that lives inside a macro system where interest rates, liquidity, regulation, and human psychology all matter. Treat it as a high risk experiment inside a serious portfolio, not the entire portfolio. Size it so that you can survive the downside, not just dream about the upside. And remember, the most powerful thing you control is not the market, it's your own behavior. If this video helped you to see the Bitcoin move more clearly, you are welcome to subscribe to the channel. Here we focus on understanding the numbers, the risk, and how different assets fit together over the long term.